Look, I need to be straight with you about something that's happening right now in the gold mining sector. And if you own mining stocks, or you've been thinking about buying them because gold's been on this tear, what I'm about to show you could save you from a devastating loss. Because here's what nobody's talking about. While gold itself has been absolutely crushing it, hitting record after record, there's a massive disconnect happening between the metal and the companies that dig it out of the ground. And this disconnect? It's not just unusual. It's a flashing red warning sign that something is fundamentally broken in this market. Let me paint you a picture of what's actually going on. Gold just crossed $2,900 an ounce. That's a gain of over 40% in the last 18 months. You'd think the companies mining this stuff would be printing money, right? Their stocks should be going absolutely parabolic. But here's the thing that should terrify you if you own these stocks. The major mining indices are barely up 15% over that same period. Some of the biggest names in the industry are actually down from where they were when gold was at $2,400. Think about that for a second. The product they sell has gone up 40%, but their stock prices have barely moved. In some cases, they've gone backwards. That's not how this is supposed to work. Now, I've been watching the gold market for over 2 decades. I've seen bull markets, bear markets, everything in between. And I can tell you, when you see this kind of divergence, when the underlying asset is screaming higher but the companies producing it are lagging this badly, it's telling you something critical about what's coming next. And it's not good news for mining stockholders. Let me take you back to 2011 for a minute, because we've seen this movie before. Gold hit $1,900 an ounce in September of that year. The mining stocks had been on an absolute tear, some of them up 300%, 400% from their 2008 lows. Investors were piling in, thinking they'd found the perfect leverage play on gold. And then something happened that wiped out fortunes. Gold topped out and started drifting lower. Nothing dramatic at first, just a slow grind down. But the mining stocks? They didn't just drift, they collapsed. I'm talking 70, 80% losses over the next few years. Companies that looked bulletproof in 2011 were trading for pennies by 2015. And here's the kicker. Gold itself only fell about 45% peak to trough. The stocks fell twice as hard. Why? Because mining stocks aren't just plays on the gold price. They're leveraged bets on a whole bunch of other factors that most investors never think about until it's too late. Production costs, political risk, management execution, capital allocation, debt levels. And right now, every single one of those factors is flashing warning signs. Let's start with production costs, because this is where the story gets really interesting. The average all-in sustaining cost for gold miners right now is sitting around $1,400 an ounce. Now, with gold at $2,900, you might think these companies are making a killing. And on paper, they should be. That's a $1,500 margin per ounce. Multiply that by millions of ounces, and you're talking about massive profits. But here's what's actually happening. Those costs aren't staying at $1,400. They're rising. Fast. Energy costs have been climbing. Labor costs are up across the board. Equipment costs have skyrocketed. And the easy gold, the high-grade stuff that's cheap to extract, that's mostly gone. These companies are having to dig deeper, process lower-grade ore, and spend more money to get the same amount of gold out of the ground. I was looking at the quarterly reports from some of the major producers last week. Barrick Gold, one of the biggest in the world, reported that their costs jumped 12% year over year. Newmont, another giant, saw similar increases. And these are the well-run companies with economies of scale. The smaller miners? Some of them are seeing cost increases of 20%, 25%, even higher. Now, you might be thinking, okay, costs are going up, but gold's going up faster, so they're still making money. And you'd be right. For now. But here's the problem. Gold prices are volatile. They can turn on a dime. But production costs, those are sticky. They don't come down easily. So when gold eventually pulls back, and it will, these companies are going to find themselves in a vice. High costs, lower revenue, and suddenly those fat margins disappear. And that's not even the worst part. Let me tell you about what's happening with capital allocation, because this is where mining companies have historically destroyed the most shareholder value. When gold prices are high, management teams get overconfident. They start making big bets, expensive acquisitions, massive expansion projects, new mines in risky jurisdictions. I've seen this pattern play out over and over again. Company buys a competitor at the top of the market, paying a huge premium. Or they greenlight $1 billion mine development in some politically unstable country. And then, gold prices soften. The project runs over budget, and shareholders get crushed. Right now, we're seeing the early stages of this exact scenario. Merger and acquisition activity in the gold mining sector has picked up dramatically in the last year. Companies are paying top dollar for assets, convinced that gold is going to $3,500, $4,000, even higher. And maybe it will. But if it doesn't, or if it takes longer than expected, these deals are going to look really stupid in hindsight. There's another factor that most investors completely overlook, and it's one of the most dangerous: political risk. Gold mines are physical assets in specific locations, and a lot of those locations are in countries with unstable governments, changing regulations, and a history of nationalizing resources when prices get high enough. I'm watching what's happening in places like Mali, Burkina Faso, and other West African nations right now. These countries host some of the world's largest gold deposits, and their governments are getting increasingly aggressive about demanding bigger cuts of the profits, higher taxes, forced local ownership, in some cases, outright expropriation. Just last year, Mali detained executives from Barrick Gold in a dispute over taxes and profit sharing. The company eventually agreed to pay $85 million to resolve the issue. But that's just one example. This is happening across multiple jurisdictions. And as gold prices climb higher, the incentive for governments to squeeze mining companies only increases. Now you might be thinking, okay, these are all risks, but surely the market is pricing them in, right? The stocks are cheap for a reason. And that's partially true. But here's what concerns me. The market isn't just pricing in normal business risks. It's pricing in something much more fundamental: a lack of trust. Investors have been burned by gold mining stocks so many times over the years that there's deep skepticism about whether these companies can actually deliver sustainable returns. And the data backs up that skepticism. If you look at the long-term performance of gold mining stocks versus gold itself, it's not even close. Gold has been a far better investment. From 2000 to today, gold is up over 600%. The major gold mining indices? They're up maybe 200%, 250%, depending on which one you look at. And that's with massive volatility along the way. There were years where mining stocks lost 40%, 50% of their value, while gold was flat or even up slightly. So why would anyone own these stocks instead of just owning gold directly? The traditional answer has been leverage. When gold goes up, mining stocks are supposed to go up more. But that leverage cuts both ways. And increasingly, investors are realizing that the downside risk isn't worth the potential upside. Let me show you what I mean with some specific numbers. Back in 2020, when gold was rallying from $1,500 to $2,000, the GDX, which is the major gold miners ETF, went from about $25 to $45. That's an 80% gain on a 33% move in gold. Beautiful leverage on the upside. But then gold pulled back to $1,700 by late 2021. Just a 15% decline. And the GDX? It fell from $45 all the way down to $28. That's a 38% drop, more than twice the decline in gold. And here's the thing that should really worry you. That pattern has been consistent. Mining stocks amplify moves in both directions, but the amplification on the downside has historically been much more severe than on the upside. It's asymmetric risk, and not in your favor. Now, I know some of you are sitting there thinking, but what about the dividends? A lot of these mining companies pay decent dividends now. Doesn't that provide some downside protection? And yes, some of them do pay dividends. But here's what you need to understand about mining company dividends. They're not reliable. When gold prices are high and costs are under control, sure, they can afford to pay out cash to shareholders. But the moment conditions deteriorate, those dividends get cut. Fast. I've seen companies slash their dividends by 50%, 75%, even eliminate them entirely when the market turns. So if you're buying these stocks for income, you're building your retirement plan on quicksand. There's something else happening right now that's not getting enough attention. The quality of gold deposits being developed is declining. The easy gold has been found. The high-grade deposits that could be mined profitably even when gold was at $800 an ounce, those are mostly depleted. What's left requires more capital, more time, and more risk to develop. I was reading a report from a mining consultant last month that laid this out in stark terms. The average grade of gold ore being processed today is about 30% lower than it was 20 years ago. That means miners have to move more rock, use more energy, and spend more money to get the same amount of gold. And that trend is only going to continue. This is why you're seeing mining companies increasingly focused on mergers and acquisitions rather than organic growth. It's easier and often cheaper to buy existing production than to develop new mines from scratch. But that creates its own problems. When everyone's trying to buy and nobody's developing new supply, you get bidding wars and inflated asset prices. Which brings us right back to the capital allocation problem I mentioned earlier. Let me tell you about something that happened in 2019 that perfectly illustrates this dynamic. Newmont, the world's largest gold miner, bought Goldcorp for $10 billion. At the time, it was hailed as a transformative deal that would create a gold mining powerhouse. And on paper, it made sense. Combined production, cost synergies, all the usual merger logic. But here's what actually happened. The integration was messy. Some of the assets Newmont acquired turned out to be more problematic than expected. Costs didn't come down as much as projected. And the stock? It went nowhere for years. Shareholders who bought into the merger story got stuck in a dead money trade, while gold itself was making new highs. And that's the pattern you see over and over again in this sector. Big promises, disappointing execution, and shareholders left holding the bag. It's why institutional investors have largely abandoned gold mining stocks. The smart money has figured out that if you want exposure to gold, you're better off just owning the metal directly, through ETFs or physical bullion. Speaking of institutional investors, let me show you something really telling. If you look at the ownership structure of major gold mining companies, you'll notice that the big institutional players, the pension funds, the sovereign wealth funds, they're not major holders. Sure, they might have small positions for diversification, but they're not making big bets on these stocks. You know who is buying them? Retail investors. Individual traders who see gold going up and think mining stocks are the way to play it. And that's a red flag. Because retail investors are usually the last ones into a trade and the first ones to panic when things go wrong. When you see retail piling into a sector that institutions are avoiding, that's not a good sign. Now, let me talk about something that's really important if you're thinking about retirement and wealth preservation, because that's ultimately what this is about for a lot of people. You're not trying to make a quick buck trading mining stocks. You're trying to protect your purchasing power and build long-term wealth. And here's the reality. Gold mining stocks are not a wealth preservation vehicle. They're speculation. They're volatile, risky bets on a combination of factors that are largely outside your control. If you want exposure to gold as a hedge against inflation, currency devaluation, or economic uncertainty, there are much better ways to do it. Quick aside here, because this is relevant. If you're sitting on $100,000 or more in retirement accounts, and you're concerned about protecting that wealth, I put together a free guide on how gold IRAs work. It's in the description below. It covers how you can get physical gold into your retirement account without triggering tax penalties. Worth checking out if that's something you're thinking about. Anyway, back to why mining stocks are such a dangerous play right now. Let's talk about what happens when gold eventually tops out and starts to decline. And it will. Every bull market ends. The question is not if, but when, and how severe the decline will be. When gold starts falling, mining stocks don't just fall with it. They lead the way down, and the decline is brutal. I mentioned 2011 earlier, but let me give you more detail on what that looked like. Gold peaked in September 2011 at $1,900. By December 2015, it had fallen to $1,050. That's a 45% decline over 4 years. But the mining stocks? The GDX fell from $65 in 2011 to $12 in early 2016. That's an 82% decline. Let me say that again. An 82% decline. If you had $100,000 in gold mining stocks at the peak, you were left with $18,000. That's not a correction. That's a wipeout. And here's the thing that makes it even worse. During that decline, there were multiple rallies that sucked investors back in. Gold would bounce 10%, 15%, and mining stocks would surge 30%, 40%. People would think the bottom was in and pile back in, and then the decline would resume and they'd get crushed again. I watched this happen to people I know. Smart investors who understood the gold thesis, who believed in the long-term fundamentals, but who made the mistake of trying to play it through mining stocks. They got chopped up by the volatility. They bought the dips that kept dipping, and by the time the real bottom came in 2016, they were so beaten down psychologically that they couldn't bring themselves to buy. Now, you might be thinking, okay, but that was then. Things are different now. The companies are better managed. They're more disciplined with capital. They've learned from past mistakes. And, to some extent, that's true. The industry has improved in some ways, but the fundamental dynamics haven't changed. Mining stocks are still leveraged plays on the gold price. They're still subject to rising costs, political risk, and management missteps. And they're still going to get crushed when gold eventually turns down. The only question is whether you're going to be holding them when that happens. Let me tell you about another risk that's emerging right now. ESG pressure. Environmental, social, and governance concerns are increasingly impacting the mining industry. Gold mining is a dirty business. It uses massive amounts of water and energy. It produces toxic waste. It often operates in areas with fragile ecosystems and vulnerable communities. As ESG investing becomes more mainstream, mining companies are facing increasing pressure to clean up their operations. That means higher costs, more regulatory compliance, potential shutdowns of operations that don't meet environmental standards. And for companies operating in developing countries, the risk of community opposition and social license issues. I'm seeing this play out in real time in places like Peru and Ecuador, where local communities are blocking mining projects over environmental concerns. These aren't small projects. We're talking about multi-billion-dollar developments that could produce millions of ounces of gold over their lifetimes, and they're being stopped or delayed by social opposition. That's a risk that doesn't show up in the financial statements, but it's real, and it's growing. And it's another reason why mining stocks are becoming less attractive to institutional investors who have to answer to ESG-conscious stakeholders. Here's something else that's not getting enough attention. The correlation between gold and mining stocks is breaking down. Historically, they moved together pretty closely. When gold went up, mining stocks went up more. When gold went down, mining stocks went down more. But the correlation was there. In the last few years, that correlation has weakened significantly. There are days when gold is up 2% and mining stocks are flat or even down, and vice versa. That tells you that the market is treating them as separate asset classes with different risk profiles, and increasingly, the risk profile of mining stocks is being viewed as less attractive. Why is this happening? Part of it is the factors I've already mentioned: rising costs, political risk, capital allocation concerns. But part of it is also structural. The market for gold itself has evolved. You can now get exposure to gold through ETFs, futures, options, and even crypto-backed gold tokens. You don't need mining stocks to play the gold trade anymore. And that's reducing demand for mining stocks from the very investors who used to be their core buyers. Hedge funds and momentum traders who want leveraged exposure to gold can get it through options and futures with much better liquidity and lower risk. They don't need to tie up capital in mining stocks that might underperform. Let me show you what this looks like in practice. In 2020, when gold was rallying hard, the SPDR Gold Shares ETF, which holds physical gold, saw inflows of over $18.